Year 13. That's when everything changes with a dividend snowball. Not year 5, not year 8, year 13. Most people building a passive income portfolio have this fantasy in their heads. You invest, the dividends start rolling in, you reinvest them, and within a few years you're living off the income. But the math tells a completely different story. And when you actually see what happens year by year, you'll understand why so many people quit right before the snowball actually starts gaining real momentum. Quick disclaimer: I'm not a financial advisor and this isn't financial advice. Always do your own research before making any investment decisions. Here's what I mean. Harry starts his dividend journey with $10,000. He's using a dividend growth ETF, adding $100 every single month and reinvesting every dividend payment. In year 1, his portfolio generates maybe $350 in dividend income. Year 2, about $420. Year 3, around $500. He's looking at this thinking, okay, this is nice, but it's not exactly life-changing money. And that's the trap. Because in those early years, the snowball isn't really a snowball at all. It's more like a small clump of snow you're pushing uphill. The growth feels linear, almost disappointing. You're doing all the right things, reinvesting, adding fresh capital, staying patient, and it just doesn't seem like much is happening. But something is happening. Something you can't see yet. There's a specific moment when compounding shifts from feeling mathematical to feeling almost magical. And based on historical projections using real dividend growth and price appreciation data, that moment tends to arrive somewhere around year 13. That's when your total dividends collected roughly equal your total investment. You've essentially gotten your money back in pure income, while still owning all your shares. Let me break down what this actually looks like. Using a popular dividend growth ETF like SCHD, Schwab's US, Dividend Equity ETF, we can model this out with real historical averages. SCHD currently yields around 3.8% with an expense ratio of just 0.06%. Over the past decade, its dividend compound annual growth rate has been roughly 10%. The share price has historically appreciated around 7 to 8% annually. Now plug those numbers into a 20 or 30-year projection and watch what happens. Harry invests his initial $10,000. He adds $100 per month religiously. He turns on dividend reinvestment and doesn't touch a thing. In year 5, his portfolio has grown to around $23,000. He's collected maybe $2,400 in total dividends over those 5 years. Nice, but nothing that would change his life. Year 10. His portfolio is now worth roughly $52,000. He's collected about $8,700 in total dividends. Better, he's starting to see the curve bend, but he's still only generating around $2,300 per year in dividend income. Here's where it gets interesting. Year 13. His total dividends collected hit approximately $24,000, almost exactly what he's invested in total. His portfolio is throwing off nearly $5,000 per year in dividends alone. The annual dividend income is now exceeding what he puts in each year. This is the inflection point, the moment when the snowball goes from something you're pushing to something that's rolling on its own momentum. By year 17, the annual dividend income has climbed to match his original investment amount. He's now receiving close to $10,000 per year in dividends, equivalent to his entire starting investment, paid back to him every single year while his principal continues to grow. Year 20 is when most people's jaws drop. His total dividends collected have reached around $87,000 against approximately $34,000 in total contributions. His yield on cost, the dividend income relative to what he originally paid, approaches 50%. Half of his invested money is coming back to him annually in dividend income. And by year 30, the snowball is in full force. Annual dividend income could potentially reach 6 figures, though actual results will vary based on market conditions, dividend growth rates, and your specific contribution timeline. Total dividends collected may surpass $500,000. The portfolio value with reinvested dividends approaches $1.1 million, compared to around $400,000 without reinvestment. The difference? Nearly $700,000. All because Harry understood one thing: the snowball doesn't really take off until after most people have already given up. But here's what nobody tells you about when the snowball doesn't work. Not all dividend strategies are created equal, and the three variables that determine whether your snowball grows into an avalanche or melts into nothing are yield, dividend growth, and price appreciation. You need all three working together. Lose any one of them, and the math falls apart. Let's compare two approaches using real ETFs. VYM, Vanguard's High Dividend Yield ETF, currently yields around 2.6%, also with an expense ratio of 0.06%. It holds over 400 stocks compared to SCHD's 100, giving you broader diversification. Its 10-year annualized total return has historically been around 11%. SCHD, with its higher yield and stronger dividend growth profile, has delivered a since-inception annualized return of over 12%. Its dividend growth rate of roughly 10% annually has historically outpaced VYM's more modest dividend increases. Here's why this matters for your snowball. The dividend growth rate is the hidden accelerator. A portfolio yielding 3% that grows its dividend by 10% annually will eventually generate more income than a portfolio yielding 5% that only grows its dividend by 3% annually. It takes time, maybe 15 to 20 years, but the crossover point always comes. Think about it this way. If you're starting with a 3.8% yield that's growing at 10% per year, by year 15, your yield on cost could exceed 15%. By year 20, it could approach 25%. By year 30, you might be earning close to 50% or more on your original investment every single year. But if you chase a higher starting yield with no dividend growth, or worse, with dividend cuts, your yield on cost stays flat or even declines. The snowball never builds momentum because there's nothing adding to its mass. This is why the popular covered call ETFs with 8, 10, even 12% yields often disappoint long-term investors. That high yield looks attractive today, but without meaningful dividend growth, and sometimes with share price erosion, the snowball effect never materializes. You're essentially trading future growth for current income. There's another way the snowball can fail, and it's more subtle. Sequence of returns risk. If you experience a major market decline in years 1 through 5 of your dividend journey, the math changes dramatically. Not because dividends stop, good dividend ETFs typically maintain or even grow their payouts during downturns, but because share prices drop, which means your reinvested dividends buy more shares at lower prices. This can actually accelerate the snowball if you stay invested. Some of the best long-term dividend investors bought heavily during 2008 and 9, watching their portfolios drop 40% or more while their dividends kept coming. Those reinvested dividends at depressed prices became the foundation of enormous wealth. But if you panic and sell, or stop adding fresh capital, you miss the entire recovery. The snowball melts. Let me give you the practical framework for thinking about this. The first decade is about accumulation. You're building the base, adding shares, reinvesting every payment. The numbers won't excite you. This is the part where most people quit because they don't see immediate results. The second decade is about acceleration. The curve starts bending. Your dividend income begins to exceed your annual contributions. Your yield on cost climbs into double digits. The snowball is now visibly growing. The third decade is about domination. The compounding becomes undeniable. Annual dividend income may exceed your original total investment. The portfolio generates wealth faster than you can spend it. This is when financial independence shifts from a distant goal to something that could genuinely be within reach. Assuming historical patterns hold and you've stayed consistent with contributions. The question isn't whether the dividend snowball works. The math is settled. The question is whether you have the patience to wait 13 to 15 years before you see the dramatic acceleration. And here's what makes it harder psychologically. During those first 10 years, you'll watch growth stocks triple. You'll see your neighbor's crypto portfolio spike 1,000%. You'll read headlines about AI stocks minting millionaires overnight. Meanwhile, your dividend portfolio is grinding out 8, 10, maybe 12% total returns and paying you quarterly dividends that feel almost trivial. This is where discipline beats excitement. Because that neighbor's crypto portfolio, it might also crash 90%. Those growth stocks? Many will go to zero, The dividend snowball won't make you rich quickly, but it has historically created more wealth over 30-year periods than almost any other strategy, not because of any single spectacular year, but because of relentless grinding compound growth that never stops. Harry understood this. He didn't care that his dividend income was only $500 in year 3. He knew that same dividend stream, left alone, would likely become $50,000 or more by year 25. He wasn't investing for today. He was investing for his future self, the version of him who would eventually live off the income from decisions made decades earlier. The numbers I've shared aren't fantasy. They're based on historical dividend growth rates and price appreciation patterns from real ETFs. But they come with an enormous asterisk. Past performance doesn't guarantee future results. Dividend growth could slow. Market returns could be lower than historical averages. Unexpected economic events could change everything. What the data does suggest is this. For investors with long-time horizons, the combination of dividend reinvestment plus consistent contributions plus high-quality dividend growth stocks has historically been extraordinarily powerful. Not because of any single year's returns, but because of what happens when those three variables compound over decades. The snowball takes off around year 13. It accelerates through year 17. By year 25, it's moving so fast that stopping it would be almost impossible. But you have to survive the first 12 years first. That's the real challenge. Not picking the right ETF, not optimizing your portfolio diversification, not timing the market. The real challenge is looking at your $300 in annual dividend income and believing, truly believing, that this modest stream will one day become a river. Here's how I'd think about positioning your portfolio for the snowball effect. Start with a core holding in a dividend growth ETF like SCHD or VYM. SCHD's higher dividend growth rate historically makes it better suited for long-term snowball building, while VYM's broader diversification provides some cushion against individual stock risk. A blended approach using both could give you the best of both worlds. Set up automatic investments. The $100 per month I mentioned isn't magic, it's just consistent. Whether it's $50 or $500, the key is automation. Remove the decision from the equation. Turn on dividend reinvestment. Most brokerages offer this automatically at no additional cost. Your dividends purchase fractional shares. Those shares pay dividends. Those dividends purchase more shares. The cycle continues without any action required from you. And then do the hardest part. Wait. Don't check your portfolio daily. Don't panic when markets drop. Don't chase higher yields that sacrifice growth. Don't compare your steady dividend accumulation to your colleague's options trading account. Just wait. Because the dividend snowball will take off. It always does, for those patient enough to let the math work. The only question is whether you'll still be there when it happens. If you want to see exactly how dividend yield and dividend growth interact over different time periods, and which specific ETFs have historically delivered the best snowball effects, I break that down in the video linked here. It might change how you think about building long-term wealth from your investment portfolio.